What's up, guys? Welcome to Jeet Stock Talk, and today we're going to talk about a strategy that requires almost zero research and zero time spent looking at individual stocks or even worrying about it. You don't even have to spend time on it year to year. Just put your money in this and forget about it. So this is called a target retirement fund, specifically the Vanguard Target Retirement Fund. Now, why specifically Vanguard? Well, Vanguard is known for its trustworthiness and its dependability, and its very, very low fees. In fact, its expense ratios is about 83% less than the industry average. So in this fund, you'll find that it's a bunch of ETFs. Actually, not that many. It's like 6 ETFs. Mostly has to do with the total stock market index and bonds and a little bit of international stocks too. So why the low fees? Is because you don't have to pay humans. Humans take a lot of time and money and think about what goes into your portfolio. But these funds are managed by programs and computers, and they just change it year by year and slowly take risk out by the time you get to your retirement. So today we're going to look at V4X, VFORX, VTINX, and VLXVS. So the difference between these three is how far away you are from your retirement. So the first one we're going to look at is VLXVX. So this is about 45 years from your retirement. And you'll find that most of it has the stock market index funds. In fact, about 54% of it is the stock market index funds. And these are made up of a bunch of company stocks, and this has a lot of different sectors, completely diversified, and you won't have to worry about it now. This is completely different from picking individual companies. So by picking individual companies, you increase your risk. So because this fund doesn't want you to, stay up every night worrying about what's going to happen to your money, it picks ETFs that is completely diversified. If there's a drawback on one sector, it won't affect you that much. You'll see a small decline, or if there's a huge ramp up, you also won't see the huge ramp up, but it will steadily go up in almost a linear line. So in this portfolio, you see that most of your money is in the stock market, and you'll see only about 7.10% is in the bond market. As you can see, there's only about 5 ETFs in this, with all the percentages on the right-hand side all equal to 100%. So because your retirement is so far away, this fund wants to maximize your growth right now, take more risks right now, so you can grow as fast as you can, and as close as you get to your retirement, it'll start slowly switching into bonds and have a more safe portfolio. So what is the difference? So we're going to go incremental, and we're going to jump into FVORX. Here you are 20 years away from retirement, and you'll see that the ETF has changed its percentage of pie. So you'll see now your total stock market came down a little bit to 48%, and your bond rose up to like 12%. Now this gives you a more stable fund, and you won't be immensely affected by the stock market. You'll still feel it a lot. You'll still feel it, but you won't take that bad of a hit. So you can finally see that your fund is becoming more stable, more grounded. It's not going to move that much, but you still have a lot of growth in it. This is still a little bit risky, but not as much as when you are 45 years away from your retirement. The next one we're going to look at is VTINX. Here you are 0 years from retirement. You see that most of your money is in the bond market. If something happens to the stock market, it's not going to affect you much. The stock market is only makes up about 17% of your portfolio. Now you can sleep very well and not worry about, oh, if I'm going to retire tomorrow, do I have to worry about the market crash that's going to happen tomorrow? No. If there's market crash, your portfolio is still stable. You'll have your peace of mind. You can retire tomorrow peacefully. So, what are the drawbacks of all these funds? What are the pros and cons? So for this, we'll have to look at the performance of each one. So here we can see the performances from 1 year to 3 year, 5 year, and 10 years. So we're just gonna compare the 1 and 3 years first, since the 2065 retirement fund doesn't have 5 or 10 years because it hasn't existed that long. So as you can see, your first year, because of all the corona panic and all that, this is highly unusual, but you'll see a 51% growth. That means your money grew half the amount you put in there, which is absolutely huge, okay? This is like, people dream of this, of having this, like, year by year. People want to target this year by year. And it's extremely hard to hit this. But as you can see, this fund hit a 51%. That is huge. So if you look at the S&P 500 for the last 50 years, the average is about 7 to 10%. So 50% is way out there. But as you move on to the 2040, you'll see that because more of your portfolios has bonds in it, your growth is a little bit less. It goes down to 46%. And your 3-year growth also drops from 12% to 11%, which is not much. You're doing really good. You're still beating the S&P 500. And you never had to worry about it. All you had to do is put some money in there every month and just forget about it. And you're growing at an incredible rate. And as you can see, your risk is going down slowly. Now we're going to jump into the next one where you have 0 years from retirement. And you can see that it only grew about 17% last year. This is because you have mostly bonds. Bonds don't move that much, but you still have a little bit of stock market. So usually it won't grow 17% a year. So as you can see, your 3-year dropped to 7% a year, which is about the average that you get from the S&P 500. And you don't have much to worry. You have a very stable portfolio. So here are the pros. Pros is you don't have to do your research. Just put your money in there, forget about it. You'll grow amazingly. And your cons is you don't really know what is exactly in your ETFs, which I would say you would feel a little bit uneasy if you worry about the stock market too much. So these are for people who doesn't, want to think about the stock market. They just want to live their life. These are people, remember we said category 1, who loves their work, it's their passion, loves their coworkers, love their, their life, and they just want to put their money in an account and just let it grow. This is an amazing strategy. In fact, I think that 80% of the people who are investing their money should do this strategy. It is great. It works amazingly for your retirement funds, if like 401k and your IRA. And that about concludes the retirement funds. So thanks for stopping by, and I'm signing off. This has been Jeet's Stock Talk.